Have you ever wondered why it seems like Americans and Japanese people never save money? They will tell you it is because you have to live in the moment. Because of this, you might laugh at the Chinese community for working hard and saving their entire lives, later pass away with that money still sitting in the bank unspent. Meanwhile, it seems they spend every last cent, swipe credit cards without thinking, and borrow money like crazy. In the end, they pass away, leaving their debt to the bank. Hearing this, did you actually believe it? Do you really feel that the only purpose of making money is just to spend it? Did you feel tempted to follow their lead, swiping cards and borrowing money? Don't be fooled. Everyone, listen closely. The reason Americans and Japanese people do not save, and the reason they borrow so freely, is largely because their interest rates have historically been slashed to near 0%. In fact, Japan previously had negative interest rates. That means if you dared to deposit money into a Japanese bank, not only would you get zero interest, but you would actually have to pay a fee to the bank just to keep it there. Conversely, if you borrowed money from a Japanese bank, you basically did not have to pay any interest. If you were in that situation where the more you save, the less you have, but the more you borrow, the more you have, you would probably say you want to live in the moment too. Because of this dynamic, Japan has effectively been the world's ATM for a long time. Whenever investors are out of money, they go to Japan to borrow. And then what? They swap that Japanese yen for US dollars to invest in the US stock market or US treasury bonds. Think about it, borrowing in Japan costs almost no interest. You can then turn around and buy the world's safest asset, US treasuries, which yield 3% to 4%, or even hit 5% at the peak. Isn't that just a no-brainer way to make money? You're using Japanese money to earn returns from the United States. In other words, the more money I borrow in Japan, the more I can potentially earn in the US. This is what finance experts call the CarryTrade. But here is where the problem starts. You will notice a pattern. When Japan raised rates in the year 2000, the US .com bubble burst. When Japan raised rates in 2007, the global financial crisis hit. And when Japan raised rates last year, in 2024, the US saw a massive drop in stocks, bonds, and currency. Why does this happen? It is simple. Previously, the whole world borrowed Japanese yen without paying interest. Not only did investors borrow like crazy, but they also added leverage, borrowing even more on top of that. But now, if Japan suddenly says you have to pay interest, those investors have no choice but to sell off their assets. They have to swap their US dollars back to Japanese yen to pay off the debt. So, while every financial crisis seems related to the US, if you look closely, many analysts argue the source is often Japan raising interest rates. Now, this is a big deal in 2025, because recently, Japan raised rates again, while the US has been cutting rates. One goes up, one goes down. The free money arbitrage in the middle instantly shrinks. For those using leverage, the cost instantly spikes. And how much money is playing this game right now? Its estimates suggest around 20 trillion US dollars. That is literally 1/5 of the entire global GDP. Once such a massive amount of money tries to take profit and leave, or is forced to sell to stop losses, could we be in for another crash? Is that really the case? Hello everyone, welcome to Stewardship Finance Academy. The most important reason Japan's economy has improved in recent years is that they played the game of Abenomics, named after former Prime Minister Shinzo Abe. This strategy turned Japan into the world's long-term ATM, crushing interest rates to 0% and constantly printing money. Now, Japan has a prime minister who many know is a believer in the policies of former Prime Minister Shinzo Abe. So theoretically, once this prime minister took office, shouldn't they just keep it simple? Didn't they just cut rates and print money? But instead, the government raised rates directly. Why? Many experts say it is because Japan's economy is too hot, people are spending too aggressively, and inflation is too fierce. The argument is that they have to raise borrowing costs to make it harder for Japanese people to borrow, reducing the money supply so people cannot bid up prices. But is that really true? Also, with the US cutting rates and Japan raising them, it should have scared off those playing the carry trade, but on the day Japan raised rates, Japanese yen actually dropped in value. It means after Japan raised rates, even more people swapped Japanese yen for US dollars. Why? Does this mean the Japanese yen has completely lost its value, and even raising rates cannot save it? Does this mean we do not need to fear Japan raising rates anymore? No. Or that the carry trade will not cause a financial crisis? Everyone consider this controversial possibility. What if the purpose of Japan raising rates this time is to trigger a crisis intentionally? Right now, the country holding the most US debt in the world is Japan. If Japan gets into trouble and has to sell US debt to save itself, what do you think will happen? And how should we position our portfolios? If you do not want to be a victim in this market, and perhaps even hope to move up the social class, then you can subscribe to my channel. You can expect that we will give you more critical information in the future. And if you are afraid you will forget this after listening, that would be a waste of your time. So please like this video. It will automatically be saved to your playlist, allowing you to come back and review it anytime. First off, is Japan raising rates really to suppress inflation? Let's rewind. What game has Japan been playing for the past few decades? Constantly printing money, lowering rates, even pushing rates into the negative. Theoretically, if a country prints money like crazy and there's so much cash in the market, prices should skyrocket, right? But if you go to Japan, you will notice that a bowl of ramen sold for 1,000 yen 10 years ago is still about 1,000 yen today. Prices seem completely frozen. Why? The secret is that the money Japan printed did not stay in Japan's own supermarkets, restaurants, or shops. This money was borrowed by investors, funds, and corporations all over the world. Everyone rushed to use the nearly zero-cost Japanese yen, swapping it for US dollars and euros to spend elsewhere. That is why many people do not realize that Japan has actually had a trade deficit since 2011. You can see on the charts that after 2011, the line has been below zero. This means Japan imports more than it exports. Put simply, Japan spends more money buying other people's goods than it earns selling its own. Since the money Japan prints is not spent at home, their domestic prices hardly rise. More importantly, Japan is an invisible empire holding the most overseas assets in the world. For example, Australian iron mines, Brazilian soybean farms, Southeast Asian factories, and American office buildings. The major shareholders behind countless premium assets are Japanese. Everyone, do you understand what this represents? The trade deficit means that what Japanese people eat, drink, and use is mostly bought from other countries. But because they hold countless global assets, when Australians, Brazilians, and Southeast Asians make money, a portion of that money gets distributed back to the Japanese. Most importantly, they historically haven't had domestic inflation. That means as long as Japan spends money buying other countries' goods, the inflation does not happen in Japan, it happens in those other countries. And after other countries earn Japanese money because Japan is their shareholder, they have to share a portion of the earnings back. The strategy of former Prime Minister Shinzo Abe's was to constantly print money, drop interest rates to 0%, and let the world borrow that money. This makes the Japanese yen a currency the whole world needs, just like the US dollar. Then, Japan can go around the world buying assets. But that is not to say Japan hasn't had any inflation. You will find that around 2014 and 2015, Japan's inflation tried to rise. And right now, from 2022 to 2025, Japan's inflation has shot up again. So what is inflation? Usually it is when people have too much money, and that money chases goods, bidding up prices. If that were the case, Japan should raise interest rates to make borrowing harder, suppressing prices. But look at the history. The last time Japan had inflation in 2014 and 2015, what did they do? In 2013, they started printing money. In 2014, they ramped it up. In 2015, they printed money like crazy. In 2016, they even cut rates to negative. Instead of raising rates to fight inflation, they printed more money. And the result? Inflation came down. It stayed down for 7 years, until 2022, when inflation skyrocketed again. So what did Japan do this time? They raised rates. The result? Inflation dropped a bit, but now it is rising back up. Why? If you're listening carefully, remember this. Japan's food, clothing, housing, and transport are mostly bought from other countries. Japan's inflation has never been because there is too much money at home. It is because the things other countries sell to Japan got more expensive. Simply put, if the cost of soybeans Japan buys from the US gets expensive, the food Japanese people make has to get more expensive too. You will notice looking at the Japanese yen against the US dollar, there are only two periods of significant depreciation recently. 2014, 2015, and 2022 to present. These match the times Japan's prices skyrocketed. This confirms that Japan's inflation is actually imported inflation. It happens because the Japanese yen depreciated against the US dollar. Therefore, the way for Japan to solve inflation is to make the Japanese yen appreciate and increase in value. Only if the yen is strong will foreign goods become cheaper for the Japanese people. So the question arises, will raising interest rates actually make the Japanese yen appreciate? Today, Japan raised rates. If you deposit money into a Japanese bank, they might pay you 0.75% interest. Are you rich now? No. Even if you deposit money in the US today, you might get around 3.75% interest. Even in other countries where rates are falling, you often get more than in Japan. So, no matter how much Japan raises rates, it is unlikely to attract people from all over the world to deposit their money there. What counts as a real rate hike? When the US goes from 0% to 5%, that is a hike. Since the policies of Prime Minister Shinzo Abe began, Japan's rate hasn't exceeded 1%. Instead, after Japan raised rates in 2022, the number of bankrupt companies went from 6,800 to over 10,000. Because Japanese companies survived on free borrowed money, now that they have to pay interest, they cannot survive. It is like if air was free, and suddenly you had to pay for it. To be blunt, Japan raising rates won't necessarily make the Japanese yen appreciate. It may just cause more of their own companies to collapse. What can truly bring down Japan's inflation and strengthen the yen? The method is incredibly simple. Sell US Treasury bonds. Since 2015, Japan has periodically sold US Treasuries. When they sell US Treasuries, which are priced in dollars and by Japanese yen, the yen strengthens and inflation stabilizes. They did this in 2014, and the yen stabilized. They did it in 2022, and inflation came down. But look at now. Japan has started buying US Treasuries again. And what happened? Inflation went back up. To summarize, the way for Japan to fix inflation is to sell its treasuries. But right now, they are buying them and raising rates, which hurts their own companies. Why? China is currently constantly selling US Treasuries. Who is picking up the slack? Japan. Japan has become the country holding the most US Treasuries in the world. As long as Japan continues to buy, the Japanese yen will likely depreciate, and their economy will suffer. Whether the yen goes up or down depends on whether Japan is buying or selling US debt. For us traders, we use charts to plan. If you have not learned this system yet, I urge you to click the first link in the video description and enter our SFA Stock Investment Masterclass. You do not need to pay a single cent. As long as you are a subscriber of our channel and truly want to survive in the market, we are giving it to you for free. But spots are limited, so click the link now to lock in your spot. Now, here's the most critical part. If Japan can solve its problems by selling US Treasuries, why do Japan's elites do the opposite? Why raise rates and hurt their own economy? Some analysts suggest a theory called the harvest. Step 1. The feeding. The US and Japan have a currency swap agreement. This effectively makes the Japanese yen equivalent to the US dollar. Japan acts like a mini Federal Reserve. When Wall Street needs money, they borrow from Japan. Japan then prints money and quietly buys golden goose assets globally, mines, farms, and supply chains. Step 2. The detonation. Starting in 2022, the US Federal Reserve raised rates. The world borrowed from Japan to invest in the US. The Japanese yen collapsed, triggering inflation in Japan. Then, Japan initiated a self-destruct sequence by raising rates, hurting their domestic companies. They also refused to buy their own bonds, letting the world bet against Japan. Step 3. The harvest. To save its economy, Japan will ultimately have to sell its massive holdings of US Treasuries. But these treasuries were bought when prices were high. Now that rates are up, the value of those bonds has dropped significantly. If Japan is forced to sell these bonds to save itself, they are selling at a huge loss. Who buys them? If the market crashes because Japan is dumping bonds, the US Federal Reserve might step in, print money, drop interest rates to 0%, and buy those bonds back at rock bottom prices. It would be like Japan lending the 1 trillion United States dollars, but then selling that debt back to the US for $500 billion because they were desperate. It is a massive transfer of wealth. Remember the pandemic stimulus checks? Some argue that money was funded by global holders of US debt, and it doesn't end there. If Japan's economy crashes, those massive overseas assets, the mines, the farms, might be sold off at cheap prices. Who has the cash to buy them? Wall Street investors who just printed money, they could buy the assets Japan spent decades acquiring for pennies on the dollar. Why would Japan do this? The theory is that if Japan blows itself up, it drags the global economy down with it. Once its assets are sold, it can restart its money printer and go buy up assets from other countries that crashed during the chaos. This is just one perspective, but it shows that Japan raising rates has everything to do with your wallet. If you feel investment is a skill you need, and you want to see how we position ourselves, join our SFA Stock Investment Masterclass via the link in the description. I welcome all opinions. Please leave a comment below. If you missed the details, watch my previous 2 videos as the logic connects. Next week, we will share the most critical update yet. We will continue to share free information on becoming a confident investor. Please subscribe to the Stewardship Finance Academy channel and ring the bell. I sincerely wish everyone watching financial freedom. If you found even one useful sentence today, I am satisfied. See you in the next video. Bye.